We will now compare and contrast the use of the three inventory costing methods looking at an income statement. And for first in, first out, we looked at the valuation of our ending inventory and our cost of merchandise sold. We know from doing our problems that these will vary depending on the method used. So if we have our net sales of $3,900, we have a beginning inventory of $2,000, purchases of $3,880, these will not change. What is going to change is our ending inventory and cost of merchandise sold. So it's obvious that our gross profit is going to be affected by the inventory costing method we decide to use. First in, first out, we have $1,270 gross profit. Using average cost, you'll notice the net sales, beginning inventory, purchases, and merchandise available for sale are the same. But our ending inventory and cost of merchandise sold are valued differently, giving us a gross profit of $1,170. Looking at LIFO, we have even less, $1,070, because again, our ending inventory and our cost of merchandise sold was valued differently. So the inventory valuation method will have an effect on your income statement by changing the gross profit because of our ending inventory valuation and our cost of merchandise sold. Remember, this is a multiple step income statement, so it does go through that whole cost of merchandise sold section. So here's a recap. Our ending inventory valuation, cost of merchandise sold, and gross profit are going to change depending on the method used. The ending inventory is valued differently at each of the three methods. You'll notice in this case, and this is not always the case, but it depends on what the purchase values were. In this case, FIFO gave us the largest valuation of ending inventory, and LIFO gave us the smallest. So then FIFO is going to give us the largest gross profit because the ending inventory is valued higher, and our LIFO is going to give us a smaller gross profit. These are the effects of on the income statement of the valuation of the inventory. We also take a look at this chart here. If you're looking at increasing costs or decreasing costs, if costs are increasing, cost of merchandise sold is going to be highest under LIFO, and it's going to be lowest under FIFO, because increasing costs for LIFO, last in, first out, the highest priced merchandise is sold last, so you'll see highest amount on the income statement for cost of merchandise sold, because that was the merchandise that was sold most currently. And you can go through that and take a look at it and realize, well, first in, first out means our, in this case, our lowest priced items in first in, first out are sold first, and we're left with the highest priced items. With decreasing costs, our FIFO, first in, first out, our smallest costs are sold first, and vice versa. So take a second to look at this chart, pause, make sure you understand that. If you have any questions as how any of these would work out, please bring them to class. Okay, we are also going to describe and illustrate the reporting of merchandise inventory in the financial statements. We already touched on this and how it affects it. We're going to look more into it now. So cost. Cost is the primary basis for valuing and reporting inventories. So inventory might not just be, though, at cost. When we talk about cost, that's how we're looking at FIFO, LIFO. That's the actual physical cost of the item. I paid this much for it. That's the cost of the item. That's what I'm going to use to value it. But we also have valuation at lower of cost or market. So we're going to value our items at whatever's lower, the cost we actually paid for it or what it's worth on the market. If you think about some things, they lose value over time. You think about a game system or a computer, a lot of technology things. It was worth more previously than it is today. So it's kind of the idea here that we're going to take whatever's less, the cost of it or the market price. So we take a look at where inventory cannot be sold at normal prices because of imperfection, style changes, or other causes. We value it at what we can actually sell it for, what would be worth on the market, because the cost would be higher and we can't sell it for that cost. Nobody wants to buy these items at that cost, so we can change our valuation method to match that need for our business. Market, as used in this valuation of lower at lower of cost or market, is the cost to replace the merchandise on the inventory date. So what it's worth at this current date, including price changes that may have happened. Cost and replacement cost can be determined for the following. You can do it for each item in the inventory, or you can do it for classes of items or categories of inventory. So each item, number one, would be like we're looking at our item XR14, item NW74. You can do it for each item, or we can do it for all of our clothing items. Pick a category as a whole, or you can take just all of your inventory. Even if you have all kinds of different types of items, you can determine that using your entire inventory. So here is an example of a spreadsheet where you have, in this case, item A, B, and C, and D. The inventory quantities, how much we have at hand. This is the unit cost, so this is the cost we actually paid for it in this column. This column shows the market price, what it's worth on the market. You'll notice item A, the price is less on the market. Maybe there's some imperfections. Item B, it's more on the market. We got a good deal. We bought it at a lower cost. The cost of it, or a market price, has gone up. C, market price has gone down, and D, market price has gone up. So to figure out the total valuation of lower of cost or market, for cost here, we take inventory quantity times the cost price gives us the cost. We take inventory quantity times the market price gives us market. Lower of cost or market ends up being market, so we're going to value this one at market price. For B, take our inventory quantity times our cost price gives us our total cost. Inventory quantity times our market price gives us the market cost. In this case, lower of cost or market, it's cost, $2,700. We're going to value it at the lower price because then when we sell it, we have more of a profit from that. You look at C, 600 at the cost price, multiply those, 600 at the market price, multiply those. This case, our market price is lower. Take our inventory times cost, inventory times market. This case, our cost is lower. Total cost, total market, total valuation that we've done. So let's take a look at a problem. We have the following data. We're going to figure out the value of the inventory at lower of cost or market. So just like the previous table we just looked at, we've got commodities C17Y and B56 or 563. We have our inventory quantities, 10 of C17Y, 7 of B563. Unit prices, market prices. So make sure you take your quantity times unit cost price to get that total cost, quantity times unit market price to get that total cost, and calculate the lower of cost or market. Pause, take a moment to do that, then restart to see if you've got it correct. Hopefully this is what you valued it at. You'll see for our item C17Y, 10 times 39 unit price cost, or so unit cost price is 390. 10 times our unit market price, 400. Lower of cost or market, it's the 390, so cost is lower. 7 times 110 gives us a cost of 770. 7 times the market price of 98 gives us 686. In this case, market price is lower. We total, and we are to complete. Hopefully you got that correct. We also have a way to value at net realizable value. So merchandise is out of date, spoiled, damaged. These might be things that are technology and are behind the times, are no longer usable or usable by very few. We write those down to their net realizable value. This is the estimated selling price less any other costs, like if we have to get rid of it to dispose it or sales commissions, we go ahead and adjust for that. Merchandise inventory is usually presented in the current assets section of the balance sheet following receivables. Merchandise inventory we know is an asset, and it's a current asset because we don't plan on keeping our inventory around very long. We want to sell inventory. The more quickly, the faster we sell it, the better. So we consider it a current asset on the balance sheet. So when we choose our method of costing inventory, FIFO, LIFO, average cost, and then the method of valuing the inventory cost or the lower of cost or market, we've got to show that on our balance sheet. That way when investors are looking at it, they can know where our numbers are coming from and more accurately compare us to similar businesses. If those things aren't listed, it's no explanation on where these came from. Here's a partial balance sheet. You'll see there's the current assets section. And then we have merchandise inventory at lower of cost or market. So it shows that we value it at lower of cost or market. We don't just value it at cost or net realizable value. It's at lower of cost or market. And then it also shows that we do FIFO. So it's just a very small addition to this section of the balance sheet. So inventory errors are going to have an effect on the financial statements. We looked at how they show up on the income statement and the balance sheet. So some things that might cause inventory errors might be physical inventory on hand was miscounted. At the end of the year, we count the physical inventory on hand to see if it matches our merchandise inventory count, but we didn't count right. Human error. So that can cause some errors on the financial statements. Also, we might have incorrectly assigned costs to inventory. Think about when you were doing those FIFO-LIFO tables. If you did one incorrectly and you assigned the incorrect cost, it's not going to match up and be shown correctly. Also, inventory in transit was incorrectly included or excluded from inventory. So maybe you sold it, but you still counted it in inventory, or you bought it, but it hasn't been here yet, and you counted it in inventory. So depending on when you make those records and when you actually receive it physically on hand, if you don't keep tight records of that, it could also cause a problem. Consigned inventory was incorrectly included or excluded from the inventory. This is kind of like if you borrow something. A consigned inventory is something that you're borrowing, renting, and then you value it as inventory when in reality it's not. So here is a very useful table to show the effect of inventory errors on the period's income statement. So if we have our beginning inventory understated for any reason, that means our cost of merchandise sold is going to be understated. If we say we sold less than we did, it's going to make a higher gross profit. And then our net income is going to be overstated because gross profit affects net income. You have to think about the formulas we did where you have your cost of merchandise sold minus, or cost of merchandise sold leads to your gross profit leads to your net income. So if it's overstated, your cost of merchandise sold is going to be overstated. We said we had too much inventory. Then our gross profit is going to be understated because our costs were too big, so we have a smaller profit leading to a smaller net income. Now with ending inventory, if we have understated ending inventory, that means our cost of merchandise sold is overstated. We said too much cost, which means we showed smaller inventory at the end. Our gross profit is understated because we have less inventory to profit from, and our net income is also understated. You'll notice net income and gross profit always move together. Cost of merchandise sold is the opposite of that. So ending inventory overstated, our cost of merchandise sold is then understated, gross profit and net income are overstated. You will use this for one of your problems that you will be assigned. Finally, we've got an effect on the current period's balance sheet. This says income statement effect. It should say balance sheet. That is an error there. Same kind of idea here. Your gross profit and net income are going to move together. Your beginning inventory on your balance sheet, that's an asset in this case. If your asset is understated, in this case it's going the same as the cost of merchandise sold, being understated, and if that's understated, that means that your expenses are understated, which means you have more, shows you have more gross profit and net income, and it would work the opposite for being overstated. Your ending inventory, if it is understated, your cost of merchandise sold then is overstated. Your net income and gross profit are understated, and vice versa. I hope this helps clarify some of the concepts in the final section. Make sure you're practicing FIFO, LIFO, and average cost, and make sure you understand how it affects the income statement and the balance sheet. Thank you. Have a good day.